Zillow stock gained 23% last week, but nothing about the business really changed. The company didn't issue any press releases or make any new filings with the SEC. Rather, what happened was that the Federal Reserve indicated it would make 3 interest rate cuts next year. Those rate cuts will bring mortgage rates down, which should help home sales, and that should help Zillow, which is now the most visited real estate website in the US. The rally in the stock means that Zillow now has a market cap of $13.5 billion. Account for cash, investments and debt, and the enterprise value is just under $12 billion. But at 6 times revenue and 54 times free cash flow, some caution seems warranted. After all, 30-year mortgage rates still sit around 7.5%. Dropping that figure to something like 6.5% still leaves millions of homeowners holding mortgages at 3% or less. Those homeowners don't want to move because they don't want to give up low-rate mortgages, and so there remains a clear lack of supply in the marketplace. In fact, existing home sales are near their lowest levels since the 2008 financial crisis. However, it's worth considering another external event that helped Zillow stock last week. On Tuesday, JMP Securities upgraded the stock and said investors were underestimating Zillow's earnings power in 2025 and 2026. JMP thinks the real estate market can recover, and that will help Zillow's results return to previous levels. A key point to consider is that the US still has a housing shortage. Home builder stocks have rallied strongly this year as the country is short an estimated 6 million homes. With potentially millions of new homes being bought and sold, that can benefit Zillow. And with high gross margins of 79%, Zillow has significant operating leverage. Additional views and listings drive incremental revenues, which turn into profits at a higher rate. Bear in mind that in 2021, excluding its iBuying business, Zillow generated adjusted EBITDA of $850 million on revenues of just $2.1 billion. Obviously, that was a hot real estate market which is unlikely to return. But if buyers and sellers become more comfortable with mortgage rates, we can expect upside for Zillow stock. It's also worth noting that Zillow's web traffic remains high and its residential sales declined just 3% last quarter versus an industry decline of 14%. In other words, if the real estate market bounces back, Zillow can outperform. So Zillow represents a high risk, high reward bet on interest rates and the housing market. As such, I rate it a cautious buy, but these are my personal opinions, not financial advice, and I may buy Zillow stock in the near future. For more investing videos, visit my website at 3minutebreakdowns.com. Thank you for watching.